You may have heard the terms equities, stocks, and securities, but what does it really mean?
You are listening to Wealth Talks with the McPhees. Stocks, securities, they're such solid sounding titles. But what do we really need to think when we think of these financial tools?
Well, it's amazing that people turn to securities believing that they're secure. And as I was reminded the other day, speaking with an attorney and a client on the phone, and the attorney was saying, well, we can put you into some securities that will give you a higher rate of return than what the life insurance. And that's probably true, but those securities are not guaranteed that they will always have a higher return.
That's
Securities don't always mean that your money is secure, do they, John?
No, they don't. And, stocks are sometimes used, that term is sometimes used interchangeably with securities, but securities will encompass a lot more than just stocks. They can encompass hybrid investment vehicles and things like that. So securities is a way to refer very broadly to a term of different types of investments. And just because you buy a security doesn't at all mean that it is secure. I don't know where the name originally started, but the regulation kind of came after the fact in America. The securities were regulated after the fact. And so I don't think they would ever get away with naming something a security today if it had not been called that previously in American history.
Well, it's amazing that the Securities and Exchange Commission, as well as the Financial Industry Regulatory Authority, tell us that there's really just a few places that you can keep your money that are guaranteed. Mm-hmm. And that is certain bank products like passport savings and certificates of deposits, treasuries, that's including bills, bonds, and notes because they're backed by the federal government, and specific insurance products, including guaranteed fixed annuities and guaranteed whole life insurance products. Now, out of all of those right now, it's interesting that the guaranteed whole life insurance products for certain individuals are providing a higher rate of return and than the other entities.
They are.
And then for elderly people, the guaranteed fixed annuities are providing more security than securities.
Yeah, and they're not even securities. You cannot call a guaranteed annuity or whole life insurance policy a security. And yet they're giving a better rate of return than some of the treasury notes, bills and bonds, and even certificates of deposit that may be packaged as investments.
So let's say that we buy some stock in a company. That means we own a fraction of that company. Mm-hmm. Well, what happens if the company decides to increase the amount of shares they're going to sell? What does that do to my stock?
It's like diluting a glass of juice with some water. It's adding stock to something and diluting the value that is underlying.
And yet the amount of the dollars that I haven't been diluted. It's just the value of my dollars.
It is. And so that's a way a security can be diluted. And that's one of the reasons that a security is quite a bit different from a guarantee, because a guarantee cannot be diluted by anything except government action and something like inflation.
So when we see companies buy back their shares, what does that do to my stock if I've bought into it?
It can increase the value of it because they're buying back that share, but they're also expending capital in order to do that. And so that tends to have an offsetting effect in the short term.
So let's talk a little bit about dividends too. What are dividends and why are they different than a security?
In the securities world or dividends in the life insurance world?
Dividends in the securities world.
So a dividend in the security world is when a company makes a profit and they have extra cash on hand that they wish to distribute as a dividend to the shareholders. They can declare that dividend and pay out a certain amount per share to all the shareholders. And usually that dividend is declared. There's a declaration date. And then there is a date later on that they specify, usually at the time they declare the dividend, when that dividend will actually be paid out.
So in a security, do I really, if the market goes up, is that money really mine, or can I lose it?
The dividend money?
No, when the underlying value of the company goes up, and my stocks, maybe I bought it at $2 a share, and now it's $10 a share.
Oh, sure.
Is that an actual return that I'm getting, or does it only become actual if I cash my stock in?
If you sell the stock, because before you sell your stock, it's possible that the value could go down to $8 or $6 on that stock,
Or maybe
and
even
then,
zero.
Then the value that you thought you had would simply disappear.
Would simply disappear. Now, how does that compare to a life insurance product where I buy a life insurance product and there's something called cash value that appears in the policy, and there's a possibility of earning dividends in a life insurance policy too. So how does the dividend in a life insurance policy and the cash value differ than owning a stock?
Sure. So guaranteed cash values in life insurance, that's like your equity. When you buy a house, if you consider your house the investment, which it is for some people, you can think of the cash value in a life insurance policy similar to equity in a house.
Now we're talking
that's going to go up
specifically.
every year,
We're
as long as you
talking
make the payments.
specifically about whole life here, not index universal, or
That's
variable universal, because those cash values are completely different.
Completely different. And the dividend in a whole life insurance policy is different than a dividend in the stock market, because even though it's the insurance company declaring a profit, and they're going to share that profit back with the policyholders, but there's one fundamental difference.
It's a huge difference.
In a mutual life insurance company, when they make that profit, they're making that extra profit because they over-collected for the premiums in the first place, because they don't have any shareholders to take up the loss if there is a loss in their investments. So insurance companies, mutual insurance companies, will over-collect on premiums from their policy owners. They invest that money when they make a profit, and they don't need that money to cover the expenses of running the company and the cost of mortality, which is paying out death benefits to the people who died. Then when that happens, they have money that they need to share back with the policy owners. It's the policy owners' money. So they're basically returning that money back to the policy owners.
And that huge difference means that the IRS classifies that as a return of your premium paid, and it is not a taxable event when that happens, whereas a dividend in a stock-held company would be subject to taxation.
It would. Yeah, it would. So one of the things, when we're talking about guarantees, people say, well, life insurance has guarantees. Well, I can get a certain level of guarantees in the market as well. They say, well, for example, if they own Apple stock, then let's say Apple's trading at $140 a share. Well, they could buy a put option at $135 and say, well, now I have a level of guarantees because I know I'm at least going to be able to sell this stock for $135. Is that a guarantee, or did they simply limit their loss?
Well, that's called a limit of loss, not a gain or guarantee, because we don't know where the market's going to go.
Yeah. So how are guarantees in a life insurance policy different? Is it guaranteeing that you won't lose money, or is it guaranteeing that you're actually going to gain a certain amount?
That's really interesting. People are always wondering, well, how can they guarantee certain cash values? They can guarantee certain cash values because they can guarantee the death benefit. They wouldn't be in business if they couldn't guarantee the death benefit. So an insurance company looks at the actuarial science, realizes that they have to collect X amount of money from premium payers in order to invest that money and get a return that would allow them to pay the death benefit without going bankrupt.
Okay.
But they over-collect in premiums because they want to make sure if the market has a little bad dip in it, they still have enough money to pay any death claims that would come up.
Mm-hmm.
And they also look historically and say, well, when have there been pandemics, and when there's been natural disasters, and when have there been wars, and all this is included in that. So they are looking at the very, very worst possible case scenario of how many people might die. That's what they base our premiums on.
Mm-hmm.
But they don't need those premiums because we didn't have a pandemic, and we didn't have a war, and we didn't have a natural disaster, and we didn't have a bunch of people dying. And the market did really well for them. Those are the dividends that they pay back to policyholders based on how much premiums that you've paid in and they're managing for you.
Mm-hmm. So the guarantee in life insurance policy can go up every year, whereas a guarantee in the stock market is really only what you've put in place by hedging to try and limit a possible loss.
That's correct. Yeah.
Okay. So that's a fundamental difference there. In life insurance, the guarantees that you have can actually be a gain plus the dividend. If there is a dividend, if the market does well, you have the opportunity to participate in that. That brings up the question of what about, and you mentioned universal life insurance a little bit earlier here. What about universal life insurance? Because that's the thrill of especially the indexed universal life insurance that's out there is, well, you have a certain foundation of guaranteed values in a universal life insurance contract, but you also have the opportunity to participate in the market. Is that any different than what whole life guarantees and possible dividends would be?
Well, the insurance companies that sell universal life products always tell me that they like it because it puts the risk back on the policy holder rather than on the insurance company. And to me, that's just counterintuitive. If you're buying insurance, you're trying to protect for the unknown possibilities of the future. So why do you want to assume part of that risk back? And universal products, 100% of them are based on buying the most expensive type of insurance that you'll ever buy in your life for your lifetime, and that's term insurance. Now that sounds contrary to what probably most people listening to have heard. Most people have heard that term insurance is the cheapest insurance you can buy.
Term.
For short term, it is if you're young and healthy.
Sure.
The older you get, the more expensive it's going to get. And as it gets more and more expensive, it comes to a point where all the extra premium that you've paid for a very cheap term product, which universal life is based on, has been accumulating in the cash value account, earning some type of interest rate, either from a LIBOR or from an indexed product or from variable investments. If those have not produced enough extra money in the accumulated cash value, you will spend all that accumulated cash value buying term insurance and then run out of insurance.
And that's an indexed universal life.
There have been millions and millions of dollars spent settling claims on people who thought they were buying a product that would last them their lifetime. And the insurance companies got sued because their contract expired, collapsed. There was no coverage. There was no cash value. And the insurance company had to come back and pay those people because they thought they were buying something that would last them a lifetime.
Mm-hmm. So that's if the investments don't work out so great. What about on the guaranteed side of the index universal life? Does that offer any protection? Because there's at least supposed to be some sort of guarantee in those products. What is the guarantee exactly?
Many times the guarantee is only that you won't lose money if the market or the interest index that they're following goes to zero or below zero. However, there are still fees associated with how much premium you're paying on an annual basis. And those premiums that are paid are usually charged somewhere around 6%. That money goes directly to the insurance company. That fee alone could cause you to lose money regardless of what the guarantees are.
Interesting. So if you paid more premiums into an index universal life policy than to support the guarantees, then theoretically it could work out, but a lot of times those guarantees don't offer the protection that you thought they were going to.
And that's the sad part about it, is that people think that this is a permanent type of life insurance, but what is permanent?
Yeah. And if you really want to be invested in the market, why wouldn't you go get your guarantees as guaranteed as possible in a whole life contract and then invest the difference in something like the market directly or the index directly that you would want to participate in?
So I think the take-home message here is that securities are not necessarily secure. Stocks are not necessarily something that you can guarantee. Life insurance, whole life insurance, is the product that is guaranteed to protect your money. And we need to be balanced on how we approach this. The foundation of anybody's life is to protect your income and to make sure that what you do put aside is not destroyed. And that is what participating whole life insurance does.
Very good. So I have two more questions for you. One, now that when you get a foundation of guarantees in whole life insurance, what one of the things that you can use those guarantees for is to perpetuate an estate. It's one of the ways that average Americans have using life insurance is to perpetuate an estate that they would not be able to do otherwise. How does that work?
Well, it's been accurately stated that 70% of wage earners in America, the only way for them to build an estate is with life insurance. Otherwise, it's not monetarily even feasible for them to do that. And for those who have been able to build an estate or who have inherited an estate, then life insurance becomes the most respected and resourceful tool to protect that estate from unnecessary taxation.
Mm-hmm.
So life insurance can build an estate for somebody, and it can protect against taxation. If you build the estate, it will protect against unnecessary taxation, so you can pass that estate on, leave a great legacy. If you've inherited it, it'll let you continue to pass on that legacy tax-free.
That's a great point. And what about on the business side? A lot of business owners, they build their wealth in their business. They don't necessarily have a lot of personal assets that are accumulated to form an estate, but their business value forms that estate. But value that's tied up in a business can be kind of illiquid, especially when you have other partners that would want to continue that business after one of the other partners dies and passes on. What are some ways that life insurance can be used, the guarantees in the life insurance, to perpetuate a business through a buy-sell agreement or something like that?
Well, interesting that you bring up buy-sell agreements. 48% of business owners, small business owners, don't even have a buy-sell agreement. They probably have never heard of it. Mm-hmm. But it's been said that if you're in business and you don't have an exit strategy, the government does. Because if you die and you want to pass that business on to your partners or someone that is going to buy that business out from you, it might be you're in a business like a doctor where your spouse and family are not licensed to even own that business. Now what do? They can't even own that business legally because they're not licensed to do it. So if you're a pharmacist or you're a doctor or you're an attorney and who you want to pass that business on when you die to doesn't have the proper credentials, you can't even do that. It's illegal.
So they might have to have a fire sale is what you're saying.
They could 90 days. They could be forced to have a fire sale to liquidate that business. If you're in a business partnership with someone else that your partners want to buy out your business, then they have to have the liquid money to do that. Mm-hmm. And like you said, many businesses don't have several, $500,000 to several $1 million just sitting around to buy out your family or your estate when you die of the shares that you have in that corporation. That's where life insurance comes in. And, starting early when you're young and healthy with that partnership makes it very, very feasible to fund a life insurance policy. Then if one of the partners doesn't die but just wants to leave, the cash values there can be a huge asset to have a retirement fund for that exiting partner that didn't die. So there are huge advantages to building life insurance and building it early in your career or your lifetime that are just overlooked by most financial planners and investment advisors today.
Yeah. And this is definitely a plan that you would want to build on guarantees and not the ever fluctuating changes that you see in the stock market.
That's correct. It might be that you start off with some term in case there's a tragedy early on, but you want to have that permanent whole life insurance in place to make sure that at the end of the road, at the end of the game, when you want to get out of the business or when you die, that transition takes place very efficiently and tax-free.
Very good. Yeah, tax-free. That's a great point. So I think there's a lot more that we could talk about estate protection and these buy-sell agreements. Let's focus on that in another show on Wealth Talks here. So be sure to stay tuned for that. We'll be planning a future show on estate protection and on buy-sell agreements, maybe two separate shows. We'll see how much material goes into that. But These are some of the things that you can use the guarantees in life insurance for that securities and stocks, despite their names, their solid sounding names, do not lend themselves very favorably. You are listening to Wealth Talks with the McPhees. We'll be back again next week.